Okay, hello and welcome back. This is Dennis Sheffield with Team Sheffield Financial Services, and we're talking about money matters. This is the third series of, I should say, third set of a series of videos that we are producing as it pertains to building financial wealth using some of the financial strategies that we incorporate. So you may recall that from the first video, we talked about establishing a solid financial foundation. And we based that on 6 principles, what we call the money management principles. And of course, those principles are paying yourself first, investing, understanding compound interest, never losing principal or never losing your initial investment, doing business with those who do business with you, and then, of course, giving back in charity. And after we talked about establishing the foundation, we moved to the second video where we talked about the building blocks that we use to incorporate a solid financial strategy. And one of the first building blocks that we touched on was the building block of protection. And within that, there are 4 things that we kind of identified that would be most important, or are the most important things to protect when you're starting to build a financial strategy. And of course, those 4 things were protecting your life, protecting your health, protecting your income, and as well as protecting your mortgage. So now here we are in the third series of the financial matters. And then the second building block that we want to discuss is that of investing. And again, this is not to talk about how to invest or what to invest, but the whole idea here is to really talk about the concept of investing to help us all gain a better understanding. So when it comes to investing, there's basically 2 approaches to investing. There's the what we call the hands-on approach, and most people may identify that with the day trader, person who's trading stocks on a daily basis, but that's not what we're talking about here. And then, of course, there's what we call the passive approach. And so to give you an example of the two, from a financial strategy, when we talk about a hands-on approach, an example that could be owning your own business. When you have a business, you manage employees, you manage stock, or I should say inventory, you manage expenses. So it's pretty much something that you're involved in on a daily basis. So again, a hands-on approach, a type of investment. And now when we talk about something that's passive, a good example of that would be a savings bond. You purchase a savings bond from some local government or some municipality, and basically what they do, the way saving bonds works is, say you buy $100 savings bond, you pay $75 for $100 savings bonds, for an example, and that bonds mature within 5 years, which means you pay $75, you pretty much do nothing. 5 years from now, the bonds mature, you can catch it in, you get $100, or if you choose, you can let it stay and continue to earn a little interest. But you see, with the savings bond, that's really a passive approach. You purchase a savings bond and you don't do anything, and again, when it matures, you get the face amount. And then you find that there are some that has kind of a coalesce of both, a hands-on and kind of a passive type of approach. And a good example of that would be like a 401k that you may have in your company, meaning that after you establish your tolerance levels, the overall objective of the 401k, of course you do a suitability approach to it, and for the most part, money comes out of your pay period, your paycheck every pay period. It goes in your 401k, and that's it for the most part, because you pretty much set all your objectives up front. But one of the things that I advise my clients to do is that at least once every quarter, you want to go back and you want to look at your 401k just to make sure things are in line, it still has the proper balance that you're looking for, and of course it's still working towards the goals that you're looking to achieve. So again, that kind of gives you a combination of both, kind of being hands-on and being passive. So after we move from the 2 types of approach to investment, again, that being passive and the other one being hands-on, then what we want to do is look at the 5 areas in which we should have some investment, in which we should have our investments in, I guess I should say. And so the first area in which you want to invest is, of course, stocks and bonds. And the thing with stocks and bonds, you'll find out there's a combination of 2. There's a combination of a little bit hands-on type of approach, as well as a passive type of approach. as I mentioned earlier, for the most part, bonds are pretty much a passive type of approach. On the other hand, stocks can be, I wouldn't say hands-on like, the day trader, but again, hands-on from the standpoint you want to look at your stocks and kind of make sure that they are, going in the direction in which you choose. Now, when it comes to stocks, especially when you're first starting out, one of the things I suggest, and I suggest this to my daughter as well, is that you want to invest in the things that you know. And so, what do I mean? What do I mean about that? So, for an example, my daughter, she loves an iPhone. Okay, I'm an Android person, but of course I do own Apple stocks. But she loves the iPhones. Had iPhones for, I don't know, probably on the fourth, fifth iPhone. And because she believes in the iPhone, she's comfortable with it, she knows the product, why not invest in Apple stock? It just makes sense. And so again, that's kind of an example of investing in the things that you know. Now, here's the other thing too when it comes to stocks. So if you go to a stockbroker, some stockbrokers would tell you that you have to purchase stocks in bulk, so usually in blocks of 100s. That's not always the case. There are companies out there that will sell you a single share of stock, and as well as you can buy one single bond as well. And so when it comes to that, when it comes to just getting started, then absolutely, you don't have to buy in bulk. You can buy a single share of stock. And then the thing is with that also is that hopefully it's in a company that you have a company where you are utilizing their products. But if not, again, you can purchase a single share of stock. So again, just kind of get you going that you don't have to have a whole lot of money to start investing, to start buying stocks, or to start buying bonds. You can buy a single share of stocks, and you can buy a single bond. And here's the point again. One of the points that I share with my daughter is that when you think about it, the average iPhone is going to run anywhere from what, $4, $5, somewhat $600. Where when I last looked, a share of Apple stock was about $115, $120. So, just kind of look at that and think about it. So now, after we move from stocks and bonds, and the next thing that we want to invest in is real estate. And basically, what we want to do when it comes to real estate, we want to own our primary residence. I mean, even if it's nothing but a condo, and I say nothing but a condo because some people say, well, when you buy a condo, you're not buying land, you're actually just buying space. But that's, of course, is another argument for another day. But the point being here is that when we're talking about the second thing that we want to invest in, we definitely want to invest into our real estate and our primary, and we should own our primary residence. That should be the first piece of real estate that we own. And then, of course, we move out from that, we move on to income property. So it's always good to have some income property as well. And one of the things that I share with people, not that I advocate this, but depending on a certain type of timeshare that you may have that you can purchase, it can be utilized as income property. Now, I'm not saying to buy timeshare for income, but again, depending on the timeshare that you may have, that can be used as income property. And the reason why I mentioned timeshare, because timeshares can be relatively purchased inexpensively. So again, we talk about the first in terms of investment, the first of the 5 areas that we want to invest in. The first is stocks and bonds. The second is, of course, real estate. And then the third would be a business. You want to invest in some type of business. Now, and when I say this, it doesn't necessarily have to be a brick and mortar type of business. Those who have a 9 to 5, say, well, I can't have a business in a 9 to 5. But you can, but some say that they can't. But you want to invest some type of business, even if it's nothing but an online business. eBay, you can buy an eBay account and you can sell, whatever on eBay, and that can be your business. And again, even with businesses as well, businesses can be both hands-on and they can be both passive as well. And here's another advantage of having a business, especially if you have a traditional 9 to 5. Is that by having a 9 to 5 and then having a business, a part-time business, some people take their hobbies and make that out of a business. But having a part-time business can give you a tremendous tax advantage as well. Of course, you will want to talk to your CPA about that, or the person who does your taxes. But again, a business is the third thing that we want to have when we're talking about building an investment portfolio. We want to make sure that we have a business. And then the fourth thing that we want to have, or we want to do, is that we want to become collectors. Collecting And when I say collectors, not necessarily purchasing paintings, but of course, if you can afford to purchase paintings and to have a Picasso would be good. But paintings, stamps, those types of things, it's good to become a collector. And when I say collector, meaning collecting things, first of all, something that you enjoy collecting. That's the benefit of being a collector, is that you can collect things that you enjoy, but also with the hope or the understanding, the possibility that they may go up in value as well. Uh, I have a friend. He's an older gentleman. I shouldn't say friend. Well, friend slash client, older gentleman, and he likes the doo wop era. That's a style of music that they used to see back, I guess, in the 50s and early 60s. But nevertheless, he collects vinyls. The 45s, the LPs, the 33s, and the 78 types of vinyls, records, and has a very, very extensive and expensive collection. In fact, he has a couple of 45s that I didn't know they came in different colors. I always thought wax was black, but he showed me some that's in red and clear and multicolor wax. And in fact, he still has the ability to enjoy these. I mean, he's still playing on his record player, and yet these he showed me several that are like $500, $600, $700 each. So in terms of being a collector, the whole idea is to collect things that you enjoy, because you can benefit from that while you're collecting them. But again, with the whole idea of hope that they have the ability to go up in value. So as we talk about the 5 years of investing, we talked about, of course, stocks and bonds being first, real estate being the second, owning a business, and then, of course, becoming a collector of some sort. And the fifth area in which you want to invest, which I consider to be the most important of them all, is that you want to invest in yourself. Of course, in yourself, in your family, and your children. In my opinion, that's the most important investment you can ever make. And when I say investing in yourself, whether it's from a health standpoint, making sure your health gets better, whether it's picking up additional skill sets, learning to play an instrument, whatever the case may be, you always want to work on improving and making yourself better, as well as with your family. I have a lot of clients, in terms of just through years, relationships that we may have with our parents, with our children, with our siblings, those types of things. They may have a tendency to go awry, but those are things that you want to take time out, or you want to continue to invest in those things to make those relationships better. And then, of course, with your children, depending on their age, you definitely want to invest in their education, making sure that there's not something available, but making sure that there's monies available to help them further their education. Because again, without education, education is very important. So that's something that you definitely want to do in terms of investing in yourself, investing in family, as well as in your children. So as I stated at the outset, these videos are relatively short, 10 to 15 minutes in nature. And the whole idea is just to give you a concept of the things that the building blocks we can use when we're talking about building a financial strategy or financial structure. Hopefully this information I share with you has been helpful and informative. And if you are in the DMV area and you need a financial advisor, again, my name is Dennis Sheffield. I'm with Team Sheffield Financial Services. My contact information is associated with both my Facebook and my YouTube page. So until next time, we look forward to speaking with you. You have a good day. Bye-bye.